Welcome back to the Wall Street Podcast.
Good to be here.
Today, we're digging into Meituan, looking at insights from a fresh Nomura Securities report.
That's right. It's the Meituan 3690 HK Management Call Takeaways. Nomura International Hong Kong published it September 12, 2025.
And it covers the management call from the day before, September 11th.
Correct. It analyzes the competitive scene, growth targets, margin trends, basically the key outlook for 2025.
Okay, so we'll break down food delivery competition first.
Yes. Then long-term share and margin goals, retail quick commerce.
The in-store, hotel, travel side, too.
And finally, new businesses and their overseas efforts.
Great, let's jump into food delivery. Still intense.
Seems so. Q3 competition was tough, much like July and August. High industry subsidies are still a big factor.
And Meituan's response?
They're adjusting subsidies dynamically, trying to maintain that leading position.
What about average order value, AOV? I heard that's been shifting.
It has. Dropped quite a bit since May industry-wide, but Meituan's AOV, both gross and net, apparently remains higher.
Why is that? Lower subsidies on their end.
That, and they say a better order mix.
Interesting. So what's the outlook for Q4 then? Usually a bit slower.
Yeah, Q4 is naturally weaker. Fewer beverage orders, delivery costs tend to go up. Could lead to more rational competition.
Less crazy subsidies, maybe?
Possibly. There's also some speculation Alibaba might shift focus a bit.
Towards what?
More towards retail-related quick commerce, sort of mirroring Meituan's own Insta-shopping push.
And regulators. Any noise there?
Nomura mentions verbal guidance against irrational competition. Nothing concrete noted yet, though.
Okay, let's pull back from the day-to-day fight. What are Meituan's bigger long-term goals? Market share, profit.
Management sounds pretty confident. They talk about competitive advantages, strong user base, high stickiness, that efficient rider network.
And the targets.
Long-term, they're aiming for CNY1 profit per order.
€1 per order. Seems tight.
It is, but that's for the core regular meal delivery. And they're targeting 70% market share in GTV for that category.
70% GTV share and a yuan profit per order. How do they realistically defend that, especially the market share part?
Well, achieving that profit implies massive scale and efficiency, right? The 70% share. That's very ambitious. It requires leveraging their network effect, constant innovation, especially with rivals staying aggressive.
It certainly sets a high bar. Now, what about retail quick commerce, RQC? That seems like the next big frontier.
Definitely. Management sees a huge market there. They believe the total addressable market, the TAM, could top CNY 2 trillion by 2030.
2 trillion. Wow. And Meituan's plan?
They aim to keep their leading position. They expect the unit economics, the UE per order, to eventually go past CNY1.
Profit per order again, but for quick commerce this time?
Exactly, with a terminal TTV margin goal of around 2%.
So how do they actually capture that massive 2 trillion market? It's not just food delivery infrastructure, is it?
It leverages it for sure. But it's also about expanding product categories way beyond meals, optimizing delivery for different kinds of goods, and really deepening partnerships with all sorts of retailers. Getting that UE positive is key for sustainable scale.
Right, moving beyond just grabbing market share. Okay, let's look at the in-store hotel and travel segment. Any major disruptions happening there?
Nomura suggests no significant disruption is expected. Competitors like map apps, say Alibaba's AMAP, face a pretty steep learning curve.
Why is that?
In-store services require strong operational skills, onboarding merchants, managing local nuances. It's not just tech.
Got it. But there are some short-term issues in Q3.
Yeah, challenges from the broader environment. Softer demand, shifting order mix, especially as Meituan expands into lower-tier cities. That impacted margins.
Lower-tier cities, that's a big push, right? But potentially dilutive initially.
It can be, but the long-term view is positive. They expect solid GTV growth and margin recovery eventually. Low online penetration, fundamentally. There's still a huge runway for growth in China, particularly outside the biggest cities.
That low online penetration point is interesting. It means the addressable market is still largely untapped, especially locally.
Precisely. Many people, particularly in those lower-tier cities, are just starting to use digital for local shopping, services, travel. Meituan wants to bring them into the fold, adapting offerings locally. That's the long-term GTV driver.
Makes sense. Lastly, what about the new businesses and the overseas expansion? Still burning cash.
Getting better domestically. Meituan Select, that's the community group. Buying losses are apparently marginal now, expected near break-in next year.
And Yaxiang Supermarket.
Also expanding in Tier 1 and 2 cities, losses seem controlled. The report suggests all the China new initiatives, collectively, should hit break-even next year.
That's a significant milestone if they hit it. Overseas, though.
Still loss-making, but they state it's being pursued with an ROI-driven approach, so
Yeah.
careful expansion, not just growth at all costs.
Okay, we've covered a lot of ground on Meituan's strategy. Thinking about our listeners, what does all this, the intense competition, the push into quick commerce, the lower tier expansion mean for the average person for you?
Well, the high subsidies in food delivery, for now, mean competitive prices for your meals, right? That's a direct impact.
And the rise of RQC?
More convenience for everyday stuff. Instant shopping becoming more normal, less of a novelty.
And the push into smaller cities?
It signals broader access to these digital services.
Mm-hmm.
Competitive offers reaching beyond just the huge metro areas. It changes daily life, even outside Shanghai or Beijing.
So it reshapes consumer expectations everywhere.
Pretty much. Speed, convenience. The bar keeps getting raised. It forces everyone else, traditional retail included, to adapt faster.
All right, as we wrap up, here's something to consider. With this relentless drive for scale and efficiency clashing against fierce competition across so many verticals, how sustainable is this model long term? Can platform profitability truly coexist with perpetual high-intensity growth targets in this evolving digital landscape?